Hey, welcome back everybody. You're tuning in to howtoplaystock.com. My name's Kepley. Today is March 9th, 2017. In today's video, we're going to be covering mining stocks versus gold, and I'm going to show you, the difference between the two, and then we're going to go through and I'm going to show you the performance on both mining stocks and gold long term, and we're going to determine which one performs better. Okay, so keep watching, and I will see you in the next portion of this video. Okay, so we're back here, and we're going to be covering gold versus mining stocks and which ones perform better long term. But before I go into the charts and show you the charts for this, we're going to cover just a few basic things like some of the cons and pros for mining stocks, and I'm going to give you a couple ticker symbols that you can look at for gold and silver mining stocks and gold miners index. Okay, so moving forward here, the XAU, if you go out and you type in XAU, you're going to get the gold and silver mining index. Okay, now this covers like large cap mining companies in that sector, and that's what the stock basically measures, is the like the price and the production of silver in that mining index. Okay, for all those companies. The other one is HUI or HUI. This is Gold Miners Index. So those are two good stocks that you can look at that are going to measure basically the mining sector, or the companies that are tied to gold. Okay, so keep that in mind when you're looking at these. It's not actually gold itself that you're looking at when you're pulling these up. It's just it has to do with mining. Now, mining stocks are really risky, and there's they're a little bit of a different ball game than going in and playing like a regular stock. Okay, now some of the cons are, it depends on companies and management as to what you're getting into. So it's kind of like betting on the horse races. You want to get a good jockey, for whatever horse it is that you're betting on. Okay, because the jockey manages the horse. Well, it's the same thing in mining. It depends on the companies and their management as to kind of to get a better picture on how it's going to do within the mining sector itself. So I'll give you an example real quick. I've got a mining stock right now that I'm invested in, and I had to look at the management. The management is run by Rob McEwen. Okay, he's basically inducted into the Hall of Fame for mining. If that tells you anything. So he knows what he's doing. He's got great management under this company, as well as they don't have any debt. Okay, so for me, knowing the fundamentals where silver's going and looking at that company, I thought it was a great company to invest in. So I went ahead and made that investment. But I made that decision based on some of the cons that can go against you when you're betting on a mining stock. The other thing is, lower prices on gold make it harder to dig gold out of the ground. Okay, so if they can't dig gold out of the ground because it's not expensive enough, it means economically they're not going to be able to turn around and sell that for a profit because it's costing too much to dig it out of the ground. Okay, so that's another negative to mining stocks. This is another reason why they're risky. One of the pros, though, is that the mining stocks have great returns when the timing is right and when gold is on its way up. And then in the next portion of this video, I'm going to show you some charts that basically back up what I'm saying here in regards to the mining stocks going up along with gold and getting some great returns. So keep watching. I'm going to take you into the next portion of this video, and we're going to look at some charts. Okay.
Alright, so here we are, and we're looking at the dollar versus gold on a chart, and this dates back to the early 1900s. So if you're looking at this chart here, you'll notice that the dollar has lost 98.2% of its purchasing power since 1900. Okay, now the purchasing power of the USD is in green, as you can see here on the chart. Now gold has increased 53.9 times in value during that time. Therefore, so if you do the math here, 1.8% is what would be left from the 98.2% on the dollar to equal 100%. So that's where they're getting the 1.8% here. That's the difference. So you take that times 53.9 and it equals 97%. So gold has kept 97% of its purchasing power, which is amazing when you back that up against the dollar. And as you can see, if you look at the chart here, gold being in bronze, in the bronze color here, it absolutely just does exactly the opposite and takes off as soon as we start devaluing the US dollar. The other thing that I might mention here is that these charts that I'm showing you are coming from Thomson 1, World Gold Council, and the Bullion Management Group. So these charts that I'm showing you here, they're about as legit as they're going to get. So let's move forward to the next chart here. We've got gold bullion versus home stake mining. Now, home stake mining was one of the largest mining shares back in 1980. Okay, and it was a gold miner. It was one of the largest gold miners in the world at that time. So if we take a look at it, and we'll back out just a bit here so you can see the years below. Gold's in bronze again, and home stake mining is in purple. But you'll notice they're pretty close together as far as performance until about 1977. And then from there, gold absolutely explodes. And you'll see home stake mining kind of lags a little bit behind, but it still does the same thing as gold. It just doesn't perform as well. So with home stake mining, if you would have been invested, you would have been looking at about an 800% return, from a course of 1977 to almost 1980. Whereas gold, though, performed at almost 1,500%. So you can see the difference there on those two. Here's a chart showing 20 years later, and this one's pretty interesting. This shows you the HUI, which is the Gold Miners Index that I was talking about, and it's celebrating its 20th year anniversary with a loss. Which I think is interesting because you're starting to see this long term, and you can see obviously gold performs better than the gold mining index, or gold miners for that matter. You got 212% here return in 20 years on gold, and the HUI at negative 13.9%. Okay, so those are the couple charts that I have. I'm going to go back here and I'm going to show you some of the risks associated with mining. So you have exploration risks. If they can't find gold or not enough gold, they risk serious problems there because it costs money to dig gold out of the ground, and if they can't find any, well, they can go bankrupt. Feasibility risks. A company may discover gold, but at current prices it may be uneconomical to mine. I kind of covered that. I covered the management risks. Geopolitical risks. Governments can become unstable. We got financing risks. During bear markets, banks often refuse to finance operations, and because the share price of many of these companies is so low, raising equity becomes extremely dilutive to existing shareholders. Got stock market volatility, hedging policies. Basically, mining companies often lock into price agreements that end up destroying shareholder value when major changes in operating costs related to bullion prices occur. I'll back out just a bit here. Jurisdiction risks. So you got uprisings, wars, political upheaval, disasters, stuff of that nature is also a risk. That's mining companies for you, and the risks associated with those. Now we'll go over here to the gold bullion risks, and we'll look at those real quick. With gold bullion, just strictly gold, the risks associated with that are losing physical gold, and it's significant if it's not vaulted in a safe location. So you want to make sure you have your gold in a safe place. The value of gold is priced in relation to fiat currencies. Monetary and fiscal policies are a major contributor to the fluctuation in currencies. You got supply and demand fundamentals that affect the price and availability. Futures contracts bought and sold by institutions such as central banks, hedge funds, and banks can adversely affect the price of gold because there is more paper gold than physical gold. And if you don't know what I'm talking about, I'll put a link in the description here to my previous video because I covered that in great detail. But there you have it, guys. That is the difference between gold versus mining stocks and the performance long term on those. If you have any questions or you like the video, go ahead and hit the like button. You can also subscribe to the channel and let me know your thoughts on this video because I thought it was pretty interesting. Until next time, you guys remember, stay patient. Income is the outcome, and these are today's investors' investing tips. You're tuning in to howtoplaystock.com. I'll talk to you guys later.